Good morning, everybody. This is Patrick MontesDeOca with the Equity Management Academy live trading room, streaming live in YouTube. I hope everybody had a great weekend. As we come into this week, we have a little bit of choppiness this morning, a little bit of volatility this morning, some mixed signals in the metals, also in the digital asset base. We're going to be taking a look at the daily, weekly, and if we have some time, into the monthly report here as we move in throughout the day and also throughout the week. We're moving into a critical time, and so we want to make sure that we keep you updated in terms of the changing indicators that we're looking at here for the remainder of the week and also for the remainder of the year. We'll be right back shortly. Welcome back, everybody. Here, let's jump right into the markets here. Take a look at the metals markets. A little bit of a choppy area here. Let's take a look at the gold market here. The average price here for the day, we're looking at about 1822. Let me double check and make sure that we're looking at the daily levels here. 1808, 1809 is the buy one level, and we're looking at the roughly about 1800 at the buy two level here. In looking at just where we are here this morning, we seem to be once again validating and confirming the support of the 1810 moving average, which is the 360-day cycle average that essentially is the overwhelming level of support. And we're looking at gold holding that level. It's critical that it holds the level of 1810, as it is a very, very strong indicator when we're looking at the 360-day cycle. One of the things that I want to share with you this morning here, let me just take a look at something here, and what I want to do here is share with you the silver weekly reports that we just published, produced by the AI, and let's take a look at it and see what it looks like for the rest of the week.
Hi everyone, this is Equity. Hi everyone, this is Equity Management Academy with the weekly silver report for July 30th, 2021. Summary. The weekly trend momentum of 26.40 is bearish. The weekly VCPMI of 25.31 is bullish price momentum. A close below 25.31 stop negates this bullishness neutral. If short take profits 24.75 to 23.95. If long take profits 26.11 to 26.67. Trading instructions. Weekly trend momentum, 26.4, bearish. The silver futures contract closed at 25.57. The market closed below the 9 SMA 26.40 is confirmation that the weekly trend momentum is bearish. A close above the 9 SMA would negate the weekly bearish short-term trend to neutral. Weekly price momentum, 25.31, bullish. With the market closing above the VC weekly price momentum indicator of 25.31, it confirms that the price momentum is bullish. A close below the VC weekly, it would trigger weekly stops and negate the bullish signal to neutral. Weekly price indicator. Exit. Longs, sell 1, 26.11. Sell 2, 26.67. Exit. Shorts, buy 1, 24.75. Buy 2, 23.96.
What I want to do here is to review clearly how the AI basically is interpreted as we come into this week. Let's go back here to the filters that we use.
0.11 to 26.67.
The weekly trend momentum of 2640 is the first filter that we use, which is an additional filter that validates and confirms the trend momentum of the market. The weekly trend momentum is defined by the price closing above or below. And in this case, the market closing below 2640 on Friday, it activated a bearish trend momentum. So this gives us a very clear, defined mathematical direction of the trend based upon the price relationship to this pivot point. Because the trend momentum is bearish, we have now a good idea of coming into this week with a bearish sentiment. Now, the second filter that we use is the weekly VCPMI of 2531, which is the variable changing price momentum indicator, or it is the average price. In this case, we're looking at the average price or mean at 2531. The market closing above this price on Friday is a bullish price momentum. So the trend momentum is bearish, but the mean or the average price is a bullish price momentum that is defining itself against a bearish trend. Now, the third filter that we use is essentially the price action that it tells you the direction of the algorithm, that it tells you that a close below 2531 stop negates this bullishness neutral. It tells you exactly the weekly stop, that if we close below 2531, that you can use this level as your protective level, as your stop level, because this negates this bullishness, this prior bullishness defined by the mean to neutral. And if we close below 2531, it activates the levels below of 2475 to 2395. So it gives you a very, very, very defined direction of the trend, the bigger picture, the trend momentum. It gives you an average price or the mean that you can extrapolate basically the extreme levels above or below. I was asked over the weekend a very good question, and it really clicked on me that this is an important subject that I wanted to bring up during today's session, basically. And essentially, somebody asked me, how do you measure speculation in the market? Which I thought was a really great question. And one of the ways that I, as a trader, apply this intelligence, and I coach and teach my traders and subscribers in my private trading room, basically, to use the principle of the reversion to the mean. And what we do here, basically, in this live trading room is trade mean reversion. And that is essentially classifying the extreme levels of speculation. Let me put it another way. One of the main elements that I believe one has to find in the marketplace and anything that we do is, what is the average price of that product that is going by, that everybody's willing to pay? What is the average price? Once you define the average price, or basically what it's called the mean, basically that is the equilibrium of a fair value level in the market. The mean is the fair value. It's the equilibrium of price action. And once we can identify the equilibrium, then we can extrapolate the extreme levels above that equilibrium or mean, or below equilibrium or mean. When we apply the algorithm mathematically, the levels that it identifies, for example, the buy one and buy two levels. The buy one level is 24.75 to 23.95. It's telling you that on the bearishness, if it comes down to 24.75, basically the reason why the number is here is because the algorithm at this point has reached a 90% probability relative to the mean, of the relative implied volatility to the mean. So if 25.31 is the mean, you're looking at 90% at the buy one level of 24.75 probability, and the 23.95 is a 95% probability. These levels are the extreme levels of speculation. The market identifies these levels in a mathematical probability algorithm, where the extreme levels of speculation to the short side are identified. And so, understanding that if we come down to 24.75, we're looking at a 90% probability, it's already alerting us to look out for buyers or for accumulation of supply. And essentially, this algorithm tells you to begin to accumulate supply at the extreme level of speculation on the short side of the market, in this case. When we take a look at the long side of the market, and that is when the market trades above 25.31, you're looking at the levels identified to take profits at 26.11 to 26.67. Now, what I wanted to do here is break down for you the complexity of the algorithm that produces for you self-directed traders. These indicators, these targets, these levels that are built in a very complex combination of codes to provide us with this simple structure that we have. And so if you're on the long side of the market now, it tells you 26.11 to 26.67. You're looking at the extreme levels above the mean of 25.31, where you're going to or potentially expect some speculation. These are the extreme levels of speculation above the market. And as a trader, basically, what I look for is first of all, I look for the highest probabilities that I could take as a trader. I don't really care the fundamentals, although, obviously when you're trading in terms of gold and silver, the fundamentals are important. But as you can see, the fundamentals are completely skewed from the reality of what the market is doing. If you take a look at the fundamentals and you take a look at the price of silver, it's very hard to justify why silver is at these levels. It's completely the opposite of the fundamentals. So I use the VCPMI, this intelligence, as you can see, in order to identify the extreme levels above or below the mean, to identify the extreme levels of speculation. And as a trader, that is exactly what I want to look for, because that's a very short-term direction of capital, so to speak, that sometimes it provides you with some great opportunities as a trader. And the logic of the variable changing price momentum indicator is contrarian. So if you get the prices down to the extremes below the mean of 24.75 to 23.95, what you probably are going to see is the most bearish sentiment develop. The internet, the media, the rumors. And that is essentially when the market will revert. The initial target, once the reversion unfolds, is the mean, the 25.31. Once it gets through that level and it closes above, then you're looking at activating 26.11 to 26.67, which are the extreme levels above this mean. And these are the levels that we're going to be looking at for the rest of the week. So let's enjoy the rest of this sneaky presentation here of silver, the weekly report.
Trading instructions. Weekly trend momentum, 26.4, bearish. The silver futures contract closed at 25.57. The market closed below the 9 SMA 26.40 is confirmation that the weekly trend momentum is bearish. A close above the 9 SMA would negate the weekly bearish short-term trend to neutral. Weekly price momentum, 25.31, bullish. With the market closing above the VC weekly price momentum indicator of 25.31, it confirms that the price momentum is bullish. A close below the VC weekly, it would trigger weekly stops and negate the bullish signal to neutral. Weekly price indicator. Exit. Longs, sell 1, 26.11. Sell 2, 26.67. Exit. Shorts, buy 1, 24.75. Buy 2, 23.96. Look to take profits on shorts into corrections at the buy 1 and 2 levels of 24.75 to 23.96, and go long on a weekly reversal stop. If long, use the 23.96 level as a stop close only and good till cancelled order. Look to take profits on longs as we reach the 26.11 to 26.67 levels during the week.
Let's take a look at the gold report.
Hello everyone, this is Equity Management Academy, with a weekly gold report, for July 30th, 2021. Summary. The weekly trend momentum of 1820 is bearish. The weekly VCPMI of 1817 is bullish price momentum. A close below 1817 stop negates this bullishness neutral. If short, take profits 1796 to 1775. If long, take profits 1838 to 1859. Trading instructions. Weekly trend momentum, 1820, bearish. The gold futures contract closed at 1817. The market closing below the 9-day SMA 1820 is confirmation that the weekly trend momentum is bearish. A close above the 9 SMA would negate the weekly bearish short-term trend to neutral. Weekly price momentum, 1817, bullish. With the market closing of the VC weekly price momentum indicator at 1817, is confirmation that the price momentum is bullish. A close below the VC weekly, it would trigger weekly stops and negate the bullish trend to neutral. Weekly price indicator. Exit. Longs, sell 1, 1838. Sell 2, 1859. Exit. Shorts, buy 1, 1796. Buy 2, 1775. Look to take profits on shorts into corrections at the buy 1 and 2 levels of 1796 to 1775 and go long on a weekly reversal stop. If long, use the 1775 level as a stop close only and good till cancelled order. Look to take profits on longs as we reach the sell 1 and 2 levels of 1838 to 1859 during the week.
And gold here, basically, the 1817 is the weekly average. And the market trading above that is bullish. Trading below is bearish, obviously. So it's important again that we trade above 1810. That is the 360-day cycle. What we're looking at here is basically the weekly, and the weekly average is 1817. 1817 is the weekly. Let me double check here. $18.20 is the trend momentum, and 1817 is the weekly average or the weekly mean. 1810 is the 360-day cycle. And then we're looking at the daily mean, actually right below that, I believe. Let me just double check. 1817, 1822 is the daily. So we're in a period where we are moving into an average, you might say, alignment harmonically between the daily, the weekly, the monthly, and basically the yearly. And that is a very strong relationship. Very strong relationship. 1809 is the monthly. Very strong alignment, indicating basically that we're looking at the possibility of the trend
59.
holding to the upside.
Trading instructions. Weekly trend momentum, 1820, bearish. The gold futures contract closed at 1817. The market closing below the 9-day SMA 1820 is confirmation that the weekly trend momentum is bearish. A close above the 9 SMA would negate the weekly bearish short-term trend to neutral.
So we're coming in here once again with the bearish. With a bullish trend momentum, but it tells you that if we close below 1817, that it negates this bullish trend momentum. And so let's continue to listen to Nikki, the advisor, the Rob advisor.
Weekly price momentum, 1817, bullish. With the market closing of the VC weekly price momentum indicator at 1817, is confirmation that the price momentum is bullish. A close below the VC weekly, it would trigger weekly stops and negate the bullish trend to neutral. Weekly price indicator. Exit. Longs, sell 1, 1838. Sell 2, 1859. Exit. Shorts, buy 1, 1796. Buy 2, 1775.
So right here, it gives us an idea if we trade below the average. The extreme below this level is 1796 to 1775, and these are the extreme levels of speculation on the short side of the market that you can expect. If we do trade above the average here, we're looking at 1838 as the sell one level to 1859. These are the extreme levels above the mean, the average price, and the extreme levels of speculation.
Look to take profits on shorts into corrections at the buy 1 and 2 levels of 1796 to 1775 and go long on a weekly reversal stop. If long, use the 1775 level as a stop close only and good till cancelled order. Look to take profits on longs as we reach the sell 1 and 2 levels of 1838 to 1859 during the week.
Are you looking for an automated artificial intelligence trading system? Do you want to analyze commodities and financial markets to determine when to buy and sell? Looking for an indicator to predict future trends in the commodities and financial markets? Welcome to EMA2 Trade Live Signals. Our variable changing price momentum indicator, VCPMI, is an automated AI trading system developed and tested over a decade. The VCPMI algorithm is based on age-old vortex mathematics combined with Fibonacci wave theory, trend analysis, pivot points, and several other widely accepted financial analytical methods. The VCPMI can help you take emotions out of your trading and rely on simple mathematics to predict future trends in financial markets. This approach will make your trading more effective, consistent, and profitable. VCPMI algorithm. The VCPMI code points and levels are support and resistance levels and behave exactly like any historical supply and demand level. Therefore, the VCPMI code levels are useful as an index tool for both day trading and for selecting and exercising entries and exits for longer-term traders. Why VCPMI? The VCPMI relies on artificial intelligence to analyze markets and predicts future movements, which seek to determine what a security or commodity is worth at a given point in time. The VCPMI uses technical analysis in the form of mean reversion trading, which seeks to capitalize on extreme changes in the pricing of a particular market based on the assumption that it will revert to its previous state. The VCPMI can be applied to both buying and selling, as it allows a trader to profit on unexpected upswings and save when security or commodity is trading at an abnormal level. Visit ema2trade.com for more details.
Have a great day, everybody. I will talk to you soon. Take care. See you soon.